Today on InvestTalk, we discussed how to diversify your retirement account type to better manage your taxes. We then talked about the market today and answered some questions about Ulta, Starbucks, and declining birth rates, then finished up with a discussion on a potential new BlackRock offering. Come check it out.
This is InvestTalk. Independent thinking, shared success.
I'm going to get to my main focus point today, which is about retirement account strategies. Specifically, how one can use retirement account strategies to reduce their taxes. Just like diversifying your portfolio, different stocks, different risks, you want to diversify the accounts you have as well between pre-tax, post-tax Roth, taxable accounts, because they can provide you with flexibility and manage your tax liability in retirement. Now, mid-career professionals and those nearing retirement need to carefully consider these types of investment accounts because each have different implications for future taxes. Right now, many individuals heavily invest in tax-deferred accounts like traditional 401ks through their employer and IRAs, which are taxed upon withdrawal based on federal brackets. However, it's often advisable to use a more diversified approach. So alongside those 401ks and traditional IRAs, that would include using pre-tax, or rather after-tax Roths, taxable brokerage accounts to provide more financial flexibility in retirement. So why is this the case? Well, one reason is that doing a mix for strategic management of adjusted gross income to potentially avoid higher tax brackets and reduce Medicare Part B and Part D premiums, something that's going to be specific for you once you're in retirement, because that's influenced by your income from the 2 years prior. Roth accounts, such as Roth 401ks and Roth IRAs, offer tax-free withdrawals as well and do not affect reported income, whereas taxable brokerage accounts are subject to capital gains tax. These are typically lower than the top income tax rates, with long-term capital gains tax anywhere between 0 and 20%, but it really depends on your overall income. Another benefit of tax diversity is that the tax laws today are not guaranteed to be the tax laws of tomorrow. People often also don't consider their own personal financial circumstances, as Roth accounts allow you to withdraw the contributions, just the contributions, without penalty, and brokerage accounts offer you the most flexibility of all your options. When moving into retirement, brokerage accounts are advantageous for those considering early retirement before 59 and a half. Why? Because they don't incur the typical 10% penalty associated with early withdrawals of gains from your retirement accounts. Remember, within the Roth, you can withdraw the contributions, but you can't withdraw those gains without penalty. Now, each type of account has its own place, its own benefits, and its own costs within your full financial profile. So investors would do well to consider this type of diversity as well when planning for their financial future.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Let's talk about the market today. U.S. equities were higher, once again ending near best levels. It was a rip-roaring day for U.S. small caps. The Russell 2000 up 3.5%. Breadth notably positive. The equal weight S&P outperformed the official index by over 100 basis points. Though, regardless, the S&P 500, NASDAQ, and Dow Jones all capped off more record closes. This coming after U.S. stocks finished higher on Monday as well. Small caps have now rallied for the 5th consecutive session. I believe this is the largest 5-day outperformance of small caps relative to large caps in the history of markets. So make of that what you will. Today's other outperformance, with the exception of small caps, included managed care. We talked about a managed care name earlier. Banks, investment banks, home builders, retailers, big tech, mostly lower. Other laggards, relative laggards, because the market was broadly up, included semi, software, energy, copper, and aluminum names. Gold ended up 1.6%, posting fresh record closes as well. Crude oil down 1.4%. Tuesday saw an extension of this recent rotation we've seen out of tech and into those value cyclical small cap names. Analysts were overall optimistic on the durability of this broadening given factors including soft landing support, disinflation, and expectations around the Fed easing. Market now pricing in 100% chance of a September rate cut and a 65 basis point, or rather they're anticipating 65 basis points of cuts by year end. Earnings also continuing to hold up despite the high bar of growth year over year. And so what you're seeing now is really FOMO becoming to be a tailwind, though some strategists continue to point to elevated valuations, weakening growth fundamentals, and ongoing debt deficit overhang as something that could drag the market back down. June retail sales also came in flat month over month, though better than consensus for a monthly decline, while May revised higher. Auto sales weak as expected, but stronger results from furniture, buildings, materials, clothing, and housing starts should be coming out tomorrow, while initial claims is coming out on Thursday. And that's the market today.
Hi, I would like to know your thoughts on a company which is something which I've been looking at for a few months now. The stock symbol is MOH, Mary, Oscar, Harry, Molina Health. I would really appreciate if you could help me with your analysis and give me some sort of an entry point or just some details about the company. If it's a good company, the balance sheet looks good, I would just like to know what the entry point would be. Thank you so much. Really appreciate it.
So the question there is on Molina Healthcare. That's ticker MOH. And Molina Healthcare is a healthcare services firm, but they really specialize in primarily underserved, impoverished communities through their Medicaid segment, and then secondarily through their Medicare segment as well. Looks like Medicaid makes up about 81% of their revenue, Medicare making up about 12% of the revenue. And so they've had a rough year, as have a lot of insurers. So if you take a look at their chart and you take a look at the chart of pretty much any managed care companies, what you'll see is, well, at the end of the first quarter, you had a steep drop off. And a lot of that was due to unanticipated utilizations dragging down those profits. And so you've seen this kind of consolidation at this level for Molina, but also for other names at the 300 level until it dropped off a little bit towards the end of last month. It's rallied today up about 8%. And a lot of that is due to the sector rotation we're seeing towards value names and specifically smaller value names. So this is a $16 billion market cap company, certainly smaller than a lot of those big healthcare services names that we all, I was going to say know and love, but certainly at least ones that we've all heard about, because everyone hates having to deal with healthcare, regardless. So this company specifically, their cash flow looks pretty solid. Their profitability has been pretty stable, honestly, over the past 3 years, even stretching back before the pandemic. On a relative valuation basis, they're trading at about 11 times forward-looking earnings. They're priced at a price to book, don't have their price to book, but the return on equity is pretty solid. It's 26.4%. So for me, this is an example of a company that's had a drawdown in price for multiple reasons. One, they were valued a little bit more highly during the pandemic. They peaked out at about $400 a share. Now they're trading at about $300 a share. But I think that the demand dynamics in the market are forcing a lot of these companies' prices down. Also, I think sector-wide, I think I mentioned this on the show last week. Somebody called in about healthcare name. There's a lot of uncertainty around the healthcare space because we don't know the policy of the next administration. If it's going to be the Biden administration, Trump administration, they certainly have differing views on healthcare. And this company is predominantly working with government-sponsored healthcare programs, Medicare and Medicaid. So for me, I think that given the downtrend in this name, it looks like it's going to head back down, even though it did rally today. I don't see it breaking much out, given the dynamics. It's still in a downtrend regardless of that rotation. And I think there's a lot of uncertainty, like I said, going into an election year. So I would keep it on my watch list because it is fundamentally a good company. It's only got about $2 billion in debt on that $60 million market cap. Billion-dollar market cap company. Like I said, profitability, cash flow, they all look good. But the dynamics out there for me, I would hesitate to be in a company that is predominantly exposed to those government plans. Thanks for the call. Now, we got a lot of ground to cover in the next 45 minutes or so, and here's some of what I have planned for you, time permitting. We're going to touch on tariffs. More specifically, what the IMF is saying about fresh tariffs and how they could impact inflation in the long term, and even interest rates. We'll also talk about how much debt the US has been issuing and how Wall Street just keeps buying it up. So what does that mean for the US's prospects of continuing to spend in increasing deficits? Should we have time at the end of the show, we'll talk about a new private markets ETF, or rather a offering of private market ETFs that BlackRock is trying to be able to offer to its clients. It's been complex. It'll probably remain complex, and that's why there's some doubters, but it'll be interesting to see what they can offer, and that's something that we'll talk about at the end of the show. We also have some voice bank questions ready to play, including one on BMY, which is Bristol Myers Squibb Company, and one on Ulta Beauty Inc. That's ticker ULTA. We also have some questions from our InvestTalk InvestTalk YouTube channel comment section. And of course, we welcome your finance and investment questions now or anytime over this next hour. Now we're going into a short break, and on the other side, we'll take your questions on the InvestTalk Anytime listener line. Feel free to call now at 888-99-CHART.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Now, shifting gears back to answering your finance and investment questions, which, as I say time and time again, is what I really like to do. And this one is coming from our InvestTalk YouTube channel. That's InvestTalk with 2 T's. And so when you go over there and you watch our videos and you look at us, don't know why you would, and you want your question answered, go to the comment section, leave it. We like to get to those as quickly as we can. So this one is about declining birth rates. It says, long-term, should investors be worried about declining birth rates and the following population declines? So, that's an interesting question. This has been in the news, I think, a lot over the past 5 years, which is kind of paradoxical because several decades ago, people were talking about overpopulation. Now the worry is underpopulation. And I think one of the causes of this is the aging workforce. Now, with respect to the US, I think the demographic dynamics are not as dire as it are in some parts of South Korea. Some Asian countries have some pretty dire demographic dynamics. And so that's why it's even more interesting to me that this question is coming into play at a time where there's the potential for ramping down immigration policy, right? So there are 2 ways to increase the workforce, correct? You can have higher birth rates within your country, or you can import workers through immigration. So I think that declining birth rates, in summary, is more of an issue for countries outside of the US. I'm not saying it's not a problem within the United States, but the things that are probably going to affect the labor force over the next 5-10 years are actually other factors outside of the declining birth rates. Though I will say that birth rates declining within Asia, within East Asia, are probably going to weigh down on Chinese markets, Korean markets, and the like. Thanks for the comment. Now let's play another caller question. You know the number, 888-99-CHART.
Hi, this is Said from Charlotte, North Carolina. I have a question regarding Bristol Myers, ticker symbol B as in boy, M as in Mary, Y as in yellow. I don't understand the negative PE, so probably that could be the Yahoo software that I'm using, but it looks like 52 weeks low. I'm not sure whether the dividend is reliable, but at this point, what is your take on the entry point? Thank you so much for your time. Have a great day. Bye-bye.
Okay, so taking a look at BMY, that is Bristol Myers Squibb Company. It is a pharmaceutical company. And I think one of the major issues here with this name and a lot of pharmaceutical companies is they tend to go through waves. Why do they go through waves? Well, sometimes they face patent cliffs. So this specific name is facing a patent cliff in 2027 with their drug. I think it's called Eliquis. And it was responsible for I think over 12 billion, 12 to 15 billion of revenue. And so that's a big revenue stream for this company. And you've seen that revenue peaked out in 2022. It declined a little bit into 2023. It's supposed to be pretty flat going into this year. On an inflation adjusted basis, it's certainly down. And so over the past year, you've seen this name fall about 33%. It actually has a consensus hold rating from analysts. And you see this huge divergence really happening at the end of 2022. Now, the company is likely developing new drugs to replace its older drugs. And so the question that you asked is it a good investment? I think in the short term, maybe not, given the dynamics of their patent cliff. Now, is their dividend reliable? It's 5.8% dividend right now, given the market drop off. I mean, they have $41 billion in debt on an $81 billion market cap company. They're not too levered. That's 7 times on interest earned. They are, again, projected to make less money this year, but their cash flow is plenty. Their dividend payout ratio is only 59. I think their dividend's probably sustainable here, but it's more about just the dividend, right? It's about the company that you're investing in, because you're exposed to, when you think about total return, your capital appreciation, your capital gains or losses, and your dividends. So though I don't think that this company, given its current operating cash flow levels, given the fact that it is not too levered, given that it has $12 billion in cash and short-term investments, is going to, in the short term, shrink its dividend. I think that given the dynamics of the drugs that it currently has, we have to just wait a little bit to see what they got going on. I think it's going to probably keep falling down for the foreseeable future. Thanks for the call. We're going into a break. James from New York, hang on. You will be next on InvestTalk when we come back. Feel free to call at 888-99-CHART. Do you want to take your investment strategy to the next level?
We invite you to visit investtalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to investtalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
James, thanks for holding on during the break. How can I help you?
Yeah, how are you today?
I'm doing well. How about yourself?
Doing fine. I was going to ask you about the purchasing of call options and how to best determine a strike price when doing so. Should it be based on the strike price? Should it be based more on the implied volatility of the underlying security? What is the best way to sort of determine that if you're bullish on a security and want to buy call options?
Yeah, I think that's a pretty complicated question because options are generally pretty complicated instruments. So people tend to buy options for multiple reasons. One is to hedge their portfolio. Another is because they're pretty bullish on what they expect the performance of the underlying to be, and they want to make a leverage bet. So I think that first and foremost, you need to think about what your time horizon is, right? So if it's a shorter time horizon, what you're going to see is less theta effect, right? Because there's less time to decay there. But generally speaking, you should probably be looking at the implied volatility of the option, the volume of the option, right? Because you want to be able to get in it, you want to be able to get out of it, and what recent kind of like movements in volatility of the underlying asset look like. But overall, that's a short answer to an incredibly complicated question. I think generally for me, if you're thinking about investing, I would probably stay away from options. Options tend to be shorter term bets. Otherwise, you're probably just going to want to take advantage of theta decay over time by purchasing and selling longer dated options. But yeah, I mean, I know that's a convoluted answer, but there's really a lot that goes into options. It's a pretty complicated topic. Thanks for the call.
All right, thank you. Appreciate it.
Let's see if we can answer another quick question before we head to the break.
Hello, Justin or Luke. I have a question today on Ulta Beauty, ticker symbol ULTA. Along with Nike and Starbucks, is a very quality business with a stock price that's been dropping so far this year. So I'd like to hear some of the risk analysis on the company and a possible entry point or a long-term support level. Thank you, and I'll be listening on the podcast.
So the question is about Ulta Beauty. That's ticker ULTA. It is actually a name that I really like. And the reason why I like it is because it's pretty fundamentally sound. So taking a look at the company's sales growth, 10% year over year for the past 5 years, from 6.7 billion, 2018 projected to be 11.56 billion, though that's not a great increase from last year, but we'll talk about that in a sec. Still, there's pretty consistent growth there. And it's taken a hit this year. You mentioned Nike is one of those other names that's taken a hit as well. Ulta is down 16% year to date. From a balance sheet perspective, it's got about $2 billion in debt on an almost $19 billion market cap. Its profitability has been improving. Its cash flow has been improving as well. So why has it been underperforming? Well, forward-looking guidance with respect to consumer demand. And so when stocks fall, they fall for multiple reasons. And when you have a situation like this where the company is fundamentally sound, where the company is growing, the company's cash flow and profitability are improving, and then you get the opportunity to buy it all the way back down at a 14 times forward-looking multiple, seems like a good opportunity to buy for when consumer demand starts to come back. So if you're a long-term investor, in my opinion, now would be a pretty solid time to buy into Ulta, ticker ULTA. Thanks for the call. We're heading into a short break now, and on the other side, we got some more topics, and hopefully we have more of your questions. Call anytime at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Now, in the next Invest Talk, we'll look into the story behind this question. Is the AI bubble bursting? Tech giants are backing away from AI investments while companies struggle to find practical applications. So is this the beginning of the end for the AI hype, or just a temporary setback in the industry's evolution? That's tomorrow, but today let's talk about the IMF. And the IMF, for those who don't know, is the International Monetary Fund. And they've issued a warning about the potential resurgence of inflation due to a new wave of tariffs, which could compel central banks globally to maintain higher interest rates. Now, in its latest global economic outlook report, the IMF predicts steady global growth at about 3.2% this year and a slight increase to 3.3% next year. But despite a slight reduction in the U.S. growth forecast for this year and a small increase for the Eurozone, the overall global economic situation appears pretty stable. However, the IMF is concerned, to say the least, about the inflationary pressures that could arise from increased tariffs and heightened trade tensions, particularly noting the possible economic policies of tariffs proposed by Donald Trump against China. The Republican nominee and former president has proposed significant tariffs on goods imported to the U.S. Such measures could drive U.S. inflation higher and exacerbate global trade tensions. Additionally, the IMF highlights risks associated with high levels of government borrowing, certainly another huge problem, particularly within this country, where ongoing fiscal deficits could push the debt to GDP ratio even higher to higher highs that we don't want to see. This poses risks both domestically and for the global economy. The report discussed potential economic shifts due to the upcoming election, which could lead to greater policy uncertainty. Notably, the IMF's revised forecasts also include an improved outlook for China's economic growth based on strong exports and consumer spending domestically. Forecasts for India and the UK were raised as well, while the forecast for Japan has been lowered due to supply chain disruptions. Overall, this is more evidence that a consequential election in the US will have global ramifications that may upend global trading norms and move markets. Looks like we got another live call, this time from Dana Point. Jordan, you have a question about MU. Do you own it? Or are you looking to buy it?
I own it, and I'm just wondering if I should sell it or hold on to it.
Yeah, of course. So For those of you who don't know Micron Technology, they are a semiconductor company. Or really, they operate within the semiconductor space. They have several segments. Their network computing, embedded business, mobile business unit. I think, in short, what I'm going to tell you here is that we actually bought this for clients a while back. One of the reasons why we bought it is because this is kind of instrumental within the growth of tech, but it's also been at pretty reasonable valuations for quite some time. Its 5-year average is about 1.8 right now. It's sitting at a 3 times. Its 5-year average forward-looking earnings, priced earnings is 21 times. It's sitting at about 5.2 times. And its sale growth kind of ballooned coming out of the pandemic from 21 billion to 30 billion. And now it's settled back down, but these things are cyclical. So, for us, we think that this is a good company at a pretty fair price. It's up a lot. This year, it's up 50% year to date. Its consensus price target is somewhere in the 180s. So for us, we're still holding on to it for clients, even with the recent drawdown in the past week or so. We like it. So I would say hold on to it, as long as it's not a huge portion of your portfolio. If it's appreciated such that it's over 5%, maybe you want to trim. But I certainly don't see any reason to sell it off.
Is there a price that you'd buy more if it continues to dip?
Let me take a look at the chart fundamentally. Give me 1 second. Let me take a look at this. I mean, if I'm being honest, before this chart even pulls up right now, it's trading below its 5-year range in price to earnings. It's trading like slightly above its 5-year range in price to book. And it really seems to be consolidating where it's at right now. I think there may be a little bit of a risk that it dips below like the 125 level, 120 level, but it seems to be pretty consolidated. So semis haven't been doing well in this rotation. So you're probably going to see, if this sector rotation continues, a little bit more downside, but I don't really see it dipping down below 120 or staying there for very long. So, anywhere in the 120 to 125 range, I think I think that's a good place to pick up some more.
Right on. Thanks, Luke.
Yeah, thanks for the call. Let's do 2 back-to-back. This one from our InvestTalk YouTube channel on FSTA. It says, Justin and Luke, appreciate all of your content and enjoy being able to see your screen as you discuss specific companies. Definitely a nice touch to an already fantastic podcast. My question is in regards to this ETF, FSTA. Let's pull this up here. Hopefully I can spell correctly. Okay. Fidelity's Consumer Staples Index. I don't have a lot of time to research specific companies, and I don't have any exposure to the consumer defensive sector. What are your thoughts on this ETF to gain a broad exposure for the consumer defensive sector? So FSTA is one of 10 Fidelity ETFs that tracks the MSCI sector indices. So it's tracking MSCI sectors rather than tracking Russell sectors. So you could see some differences between the sector makeup of any Russell indices, but that's not a big problem. They're a reputable and large index provider. MSCI is great. So first and foremost, it's a passive index, which means it's going to be pretty cheap, or it should be. Looks like it is. It's about 8 basis points. It's got $1 billion under management. One thing that I want to know about is tracking error. It actually doesn't show the index's return here, so it's kind of difficult to see how the index has done, or rather how the ETF has done relative to the index. But if you look at the segment benchmark, I mean, its characteristics are pretty spot on. Its price to book is about the same. Price to cash flow all looks about the same. So I think it probably does a pretty good job of tracking the MSCI sector index. So it's going to be a lot of large cap exposure, as would be expected. 87% of it, mid caps about 8.5%. It's slightly overweight mid caps and small caps, which is probably good. It's primarily within food and beverage and primarily within general merchandising retail. That makes up about 60% of the portfolio. It's a plain vanilla index. If you're looking to get exposure to the consumer staples ETF and you want to do it in a passive way, then you're going to want to do it in a passive way cheaply for a ETF that tracks a reputable index. I think this is perfectly fine. It does it in a cheap way. It does it in a broadly diversified way as well. Yeah, it's got 105 holdings. Yeah, this is about as plain vanilla as you can get. No problems with it. This is the route you want to go down. Now let's keep on going and tackle our third question. This is coming from our voice bank.
Hey, I was just wondering what you guys thought about Starbucks right now. I'm noticing the price has gone down quite a bit. Just interested to see if you guys think it would be worth picking up at this price point, if you guys see any issues with the stock going forward? I know they're looking into changing some business operations concern of what consumers are wanting out of a coffee shop now. But yeah, I was just wondering what you guys thought about the company and where it's at right now, if it would be a good long-term hold. Appreciate it.
Yes, the question is about Starbucks. That is ticker SBUX, SBUX. And we own it for clients in one of our strategies. We bought it around these levels not too long ago. And the reason why we did that is because this is an example of a company that is so ubiquitous within the US consumer landscape that falling demand due to increased prices is something that eventually will subside, and certainly they are well positioned to take advantage of a reinvigorated pickup in consumer demand, specifically around things like coffee. And so one issue with Starbucks in my mind, and something that you actually saw from their most recent earnings release, they're actually set to release earnings again in July, so that'll be interesting, July 25th. One of the things you saw in their most recent earnings release was actually that they have had some trouble actually selling coffee to their customers because they've been using a lot of app-based selling, right? They've been telling people to put their orders in the apps, and the delay is such that people just cancel it. So there isn't a lack of demand for people going to Starbucks and buying coffee. What they have to do in a different world, which is where we are now versus where we were 5 years ago, is figure out a way to, during the busy hours when people buy coffee, because primarily it's going to be in the morning, right, from 6 to 10, maybe sometime in the afternoon, but be able to capitalize on the demand from consumers during those times. So that's something they're certainly going to work on. Like I said, we own it for clients. We think that it's a pretty solid company that's currently in a little bit of a rut, but nothing too crazy to be concerned about. So we do recommend a Starbucks for our clients and also for you. Thanks for the call. Now, before we head... Oh, no, we got plenty of time. Let's talk about another talking point. So, you've heard us say this before, and certainly we will say it again and again and again. And that is that the U.S. fiscal outlook has worsened. But in spite of all of this, in spite of the worsening fiscal outlook, Wall Street remains pretty untroubled, signified by the U.S. government bonds rallying despite a pretty bleak budget forecast from the CBO. That's the Congressional Budget Office. And now the CBO projects the 2024 budget deficit to be $1.9 trillion, up from previous years, necessitating kind of an increased Treasury bond issuance to bridge the gap between government spending and revenues. Now, despite concerns that the burgeoning debt might disrupt the market, bond yields have still declined from their 2023 peaks. Now, this stability in the Treasury market amidst pretty significant debt sales reflects investors' confidence in the U.S. government bonds, which are considered the safe investment compared to other securities, the safest in the world. Now, the yields on these bonds generally set the benchmark for other borrowing costs in the economy, impacting everything from business financing to mortgage rates. Historically, Treasury yields have been closely linked to the Federal Reserve short-term interest rates, with a long-standing correlation evident over the past 6 decades. Current market dynamics, however, suggest that even if bond supply pressure yield upward, the demand for these low-risk investments can recalibrate these rates. Foreign demand is also something that is notable. That plays a pretty crucial role in maintaining the desirability of U.S. Treasuries. Their high liquidity makes them attractive to global investors, facilitating large volume trades and bolstering the dollar's status as the world's reserve currency. And despite the U.S.'s large debt, certain treasuries are considered almost as secure as cash, such as those held by foreign central banks or the Federal Reserve, making the overall debt scenario more manageable. On top of all of that, the liquidity and relatively higher yields of U.S. Treasuries compared to those of other countries like Germany and Japan ensure they remain appealing to international buy and hold investors like pension funds and life insurers. And so despite the mounting supply and the potential market adjustments, the structural attributes of the U.S. Treasury market continues to support its stability and the attractiveness to global investors. So for people that tell you that current deficits, that continued deficits in the short term are going to wreak havoc on the U.S. Treasury market, that doesn't seem to be the case. Let's pivot back to the InvestTalk voice bank for a question on SSNC.
This is Louis from Seattle. I'm calling about company SS&C Technologies, ticker symbol SSNC. I just bought some shares recently. I was looking to hold it long term. But listening to your show, it sounds like you're suggesting to step away from tech and invest into something else. Do you feel this company is worth sticking with? I don't have a big position with them. Is there a price point to look to jump in at some point? Or do you still consider buying tech again? If you have any suggestions, I look forward to your answer. Thank you.
Yeah, so I think let's take a step back. So when we say walk away from tech, we don't mean walk away from tech completely. But there are a lot of pockets within the tech space, specifically around semis, around chips, that are inflated. Some justifiably, some not so justifiably. Now, SSNC is a name that we hold for clients in one of our strategies. And it is a software solutions and financial services company. So when we talk about what's overly inflated, it doesn't really fall within that category. And you see that its price to earnings is about 12 times, 12.3. Its price to book is about 2.6, which is, well, it's actually 2.8, which is exactly at its 5-year average. And so you don't really see the overvaluation here. Its growth over the past 5 years, pretty consistent, about 10%. From 3.4 billion in 2018, projected to be 5.7 billion this year. Its cash flow pretty stable, but still increasing, as is its profitability. And so with the stable valuation over the past 5 years, even though there's been some relative strength drop off, it's performing pretty well relative to the subsector average. You see that right here. It hit a new high versus the subsector average today. And so this is an example that is, I think, a perfect example of when we say invest in certain sectors. That doesn't mean leave certain sectors alone. But when certain sectors become very inflated relative to the overall market, that's a good time where you can look and say, here's my portfolio. How are these names on a relative value basis? Given that I've been in these tech names and they've appreciated, maybe it's time to trim, but that doesn't mean cut it out completely. So SSNC is an example here. We hold this for some of our clients. We like this name. It's fundamentally a strong name. Very little debt. Its relative strength has been slipping a little bit, but still relative to its industry, it's doing pretty well. Thanks for the call. This is InvestTalk. I'm Luke Guerrero, and we have one goal here, and that's to help you achieve your financial freedom. Our work continues after this break, so get your questions in now at 888-99-CHART.
Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast.
John from Southern Arizona. Thanks a lot for the show. I've been learning a ton. My question today is about my employer's 401k. You know, there's a couple of bond funds, there's some target-dated funds. Mostly the ones I'm looking at are index funds. But the one that really caught my attention, I was hoping you guys could look up. I believe the ticker symbol is DFFVX, like Delta, Foxtrot, Victor, X-ray. It looks like a blend of small and mid-cap that is targeted more towards the value side of the market. A lot of industrials, but there's also a lot of micro cap in there, which sort of had me concerned besides the small and mid cap. So if you guys could take a look at that, see what you think. Thanks for all you guys do. Appreciate it.
So the question is on DFFVX, the DFA US Targeted Value Portfolio. I know it very well. I used to help manage it when I worked at Dimensional Fund Advisors. I was on the US Small and Mid Cap desk. And so I was the primary portfolio manager on this fund for a couple of years. And so I know it very well. And you nailed it. What it does is it buys US small and mid cap names. Now it goes lower than the Russell does. It goes lower than the Russell 2000 does in terms of small caps. It goes down to 10 million. And it tilts towards two things. It tilts towards value names and it tilts towards profitable names. So essentially, if you think of the US market as a slice, you're going to, in a 3D way, look for names that fill the characteristics of being both in the more oriented value buckets and the more oriented profitability buckets. Now, it is a active fund, right? It's not really an index fund because it doesn't follow the index. It takes active weights in various names. It excludes other names based on certain criteria. And it does it for a relatively low expense ratio, about 27 basis points. It's an ETF, so it's not an ETF. It's a fund, so they do some tax management there, but it's not going to be as tax efficient as an ETF is, just by virtue of it being a mutual fund. So I think it's a great way to get exposure to the US SMID cap value side of the market, and so no complaints there. Certainly. I know the people that run it. They're very smart people. So good fun, DFFVX. Before we head off for the day, I wanted to talk about another asset manager, a different one, BlackRock. And they've been trying to integrate private assets into the ETF market. Industry experts, however, and me, are pretty skeptical. But in an effort to move forward, BlackRock acquired Preqin, don't know how to pronounce it. It's a UK-based private markets data group. And they intend to use the data to potentially develop investable indices for exchange-traded products. So what's stopping them? Well, the first thing that come to mind is the inherent illiquidity and valuation challenges of private assets make them kind of an awkward fit for ETFs. ETFs are designed for liquidity and daily pricing. But in spite of that, the acquisition, which cost £2.5 billion, positions BlackRock to potentially revolutionize ETFs by incorporating private equity, venture capital, and other private assets. Although how they plan to address the liquidity mismatch is kind of unclear to me. Critics argue that such a move could be problematic, especially as regulatory bodies are increasingly concerned about liquidity mismatches in funds. And so the broader strategy seems to align with BlackRock's transformation from just an asset manager to a comprehensive financial services entity, getting into Bitcoin, for example, leveraging its Aladdin platform and expanding its data and indexing offerings. And so the future of this initiative could involve creating synthetic exposure to private assets through derivatives, a method that remains kind of speculative, but aligns with the industry's innovative push towards these diverse and accessible investment products. So straight from BlackRock, more funds with more options for more people, more risk. What could possibly go wrong? Interestingly enough, we talked about AI in the most recent newsletter. And, for those of you who don't know, traditionally we would talk about the current market environment, but that doesn't really change much week to week. So if you're interested in the newsletter, which comes to your inbox every Saturday, keep in mind there's a new section there, which we just started, called KPP Insights, where we look into a different topic every week. Last week was AI. This week, still to come. Now, I'm Luke Guerrero. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And while you're there, please be sure to rate and review us on any of those platforms. As I hope you've been made aware of, because certainly if you haven't, we haven't been doing our jobs. Our podcast is also available on video form on our InvestTalk YouTube channel. That's InvestTalk with 2 T's. Come check it out. I've been growing a beard. It's getting bigger and bigger. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.